In the ever-evolving world of trading, whether it's stocks, forex, or commodities, mastering the art of risk management is pivotal. It is what separates seasoned traders from novices. While strategy, timing, and analysis are crucial, without solid risk management, even the most promising trades can lead to significant losses. Here we delve into the essentials of risk management in trading, offering you actionable strategies to safeguard your capital and optimize your trading performance. Risk management in trading involves identifying, analyzing, and accepting or mitigating uncertainty in investment decisions. Essentially, it is about making calculated decisions to minimize potential financial losses. This aspect is often overlooked by beginners who focus primarily on the potential gains without adequate consideration for the inherent risks. One of the most fundamental principles of risk management is setting limits on how much capital you are willing to risk on any single trade. A common rule of thumb is to risk no more than 1 to 2% of your total trading capital on a single trade. This means that a significant loss on one trade won't jeopardize your ability to perform future trades. A stop-loss order is an order placed with a broker to buy or sell once the stock reaches a certain price. A stop-loss is designed to limit an investor's loss on a security position. Setting a stop-loss order for 10% below the price at which you bought the stock will limit your loss to 10%. Similarly, take-profit orders are set up in a way to secure your profits before the market turns. Diversification is often touted as the only free lunch in finance. By spreading your investments across various financial instruments, industries, and other categories, you can reduce the risk of a single event impacting your entire portfolio significantly. This strategy can help you achieve more stable returns over time. Leverage can be a powerful tool in trading, allowing traders to magnify the financial outcomes of their trades. However, the potential for higher profits comes with the risk of increased losses. Therefore, it's crucial to understand how leverage works and to use it judiciously, keeping in mind the added risk it entails.
Up. Nice.
Keeping up to date with market changes, trading techniques, and financial news can significantly enhance decision-making. Alongside this, managing your emotions is critical. Fear and greed can cloud judgment, leading traders to make rash decisions or cling to losing positions for too long. Practicing discipline and keeping a trading journal can help in managing these emotional aspects. Now that we understand what risk management in trading is, allow me to show you how to properly incorporate it into your trading strategy, so you won't be afraid of any losing trades. As mentioned earlier, the standard way of applying risk management is by risking a certain percentage of your account balance. For example, purpose, I am going to use a $500 balance with a risk tolerance of 5%. The 5% is just a personal preference, as I do believe 1-2% is way too low for you to make any money that can supply your daily expenses. Another thing that you have to understand is the risk-to-reward ratio. This is the amount that you are risking to lose to gain a profit, which would be your reward. For example, a risk-reward ratio of 1-to-1 means that you are risking $1 to get $1. However, a risk-reward ratio of 1-to-2 and 1-to-3 means that you are risking $1 to get $2 to $3. On the flip side, this means that in one favorable scenario, you won a trade while using a 1-to-2 risk-reward ratio. It means that you won $2. However, if it were to be a losing trade, it means you've lost only $1. This means that if you were to place 3 trades and won only one while losing the other 2, your profit loss would be at break even. That's because you would need to lose 2 consecutive trades to be in a loss. This goes without saying that its risk management makes it harder for you to lose your entire account balance while making it much easier for it to grow. I know what you might be thinking then. If risk management makes losing your account so hard while making growth so easy, then how is Forex still so hard to the point that 95% of traders still failed? The answer is simple. That's because risk management doesn't make Forex trading easy.
Hold up. Wait a minute.
Something ain't right.
Applying proper risk management makes it harder for a trader to blow his entire account on one to a few given trades. However, proper risk management by itself is not enough to grow a Forex account, nor is it enough by itself to become successful. Yes, it's one half of the crucial components needed to become a profitable Forex trader, with the other half being a Forex trading strategy. As regards having a Forex trading strategy, we've already covered that in a previous video, showing you how to create a profitable break and retest strategy, so we are not going to go too deep into that topic, but you would be able to access the full video using this card on the screen, or the link in the description of the video, or the pinned comment. So let me show you some key pointers that you would need to take into consideration when applying risk management to your Forex trading strategy. Your risk tolerance is the amount that you are willing to risk losing in the unfavorable scenario that the trade doesn't work out in your favor. Of course, the bigger the risk, the bigger the reward. So some traders would risk a very large portion of their account for massive gains. While this can be worth it, it is to be noted that if things don't work out in your favor, you would lose a very large portion of your account, which means you would have less room to recover bad trades because 1 to 4 losing trade was enough to destroy your entire account. Your place of entry plays a very big part in your risk management strategy. This is because opening trades at random areas in the market can have a significant negative impact on your trading results, ultimately making it difficult for you to be profitable. Your exit zones are where you take profit, and stop loss are going to be. Failure to place them or appropriate and reasonable locations could and would severely affect the profitability of your trading strategy in general. The best place to put your stop levels are at the next immediate structures. Why? Take this for example, in an uptrend, if the price breaks below the previous swing low, then that means that the trend's direction is changing. In that case, you would not want to be in that trade anymore. A take profit is best set at the previous swing high. That is because resistance is where the price tends to reverse. I am not so sure about you, but being that I can't see the future to know if the price is going to break this structure and continue to push downwards, I would rather play it safe and put my take profit here. Doing so will cause you to have a much higher probability of having your take profit hit. Of course, doing so can affect your risk-reward ratio, meaning in a lot of cases, your take profit would be lower than your stop loss, but would have a higher win rate. But if that's an issue for your trading strategy, the next recommended course of action would be to set your take profit 2 times larger than your stop loss. Wherein the type of trades you enter could be an issue impacting your risk management, such as entering long trades when the general direction of the market is going down, or entering short trades when the market is going up. Doing so would be trading against the market, and it is the quickest way to blow your trading account. The condition of the market refers to whether or not the market is trending or consolidating. In other words, going sideways. Big money is made when the market is trending either up or down. However, there are times when the market is in a period of indecision and moves sideways. During these conditions, it's very dangerous to enter any trade as the market can go in either direction at any given time without prior notification. In addition to that, during these periods, false breakouts commonly occur to trick impatient traders into thinking that the market is starting a new trend. Whether you are a scalper, day trader, or swing trader, different risk management comes into play for each trading strategy. A scalping strategy tends to have a larger lot size, with small stop losses and even smaller take profits. That's because scalping strategies aim to make quick money and get out of the market. Day trading strategies would have a trade running for a few hours to days, as it aims to hit a bigger take profit target when compared to the scalping strategy. Swing trading strategies, however, use much smaller lot sizes with very large stop levels. As such, the trades usually run for a few days to weeks. The risk-reward ratio is the amount you are willing to put at risk of losing in an effort of trying to gain something in return. Please be advised that having a large risk-reward ratio does not automatically mean you will win more. This would put you at risk of losing more.
I said, wait a minute, wait a minute. Wait, first of all, you're not going to speed past that like you didn't just say what you just said.
Take this for example. If your take profit is 5 times larger than your stop loss, that significantly reduces the chances of your take profit being hit. You should always bear in mind that there's no guarantee that the market will go as far as your take profit. The market could go halfway to your take profit, then reverse to hit your stop loss. So with that in mind, it's always best to be mindful of how far you would want to put your take profit from your entry. Risk management is not just a defensive strategy. It's an integral part of your trading approach that can contribute significantly to your trading success. By setting clear rules, using tools like stop-loss orders, diversifying your trades, understanding leverage, and controlling your emotions, you can preserve and grow your capital in the unpredictable realm of trading. Remember, the goal of risk management is not to eliminate risks, but to manage them in such a way that your goals can be achieved as safely as possible. Implement these strategies diligently, and you're well on your way to becoming a more proficient and successful trader. If you found this video helpful and want to learn more about mastering the Forex market, be sure to hit that subscribe button to join our community of aspiring traders. We release lots of valuable content like this, so don't miss out on any of it. Thank you for watching.